Good morning, everybody. It is Tuesday, July 21st, 2020. And if you were listening earlier this morning, I was on the Forex Analytics show and discussed some of our investment ideas and really the big picture, walk through the year, what we got right so far, and a little bit about missing some of the trade on this rally. But I'm going to show you that you are going to get a second chance. Do you know why? Because there is always another chance in the stock market. So all this FOMO, all you folks who are like, oh my God, I'm missing it. Shut up. It's the stock market. It goes up, it goes down, it jiggerbugs around, it goes all over the place. There is always another bull market somewhere. There is always another correction somewhere. There is always another chance. You just do your work and you find out where you should be next. So this morning on Forex Analytics, I talked about what the future looks like, how coronavirus had condensed the time frame from 8, 9, 10 years for a lot of things to happen to 2, 3, 4 years. And if we were listening to Joe Biden the other day, he made it very clear that the whole Green New Deal concept is alive and well. He's looking at about a $2 trillion stimulus to convert the grid, and combined with a FERC ruling, a Supreme Court ruling on a FERC rule, the utilities have a hard time coming, which I've been telling you the utilities are going to have a hard time coming, and decentralized energy production at the commercial level, a decentralized grid, it's all coming. The utilities will be for transmission. That explains some of the deals that we've seen in utilities lately, why certain companies are divesting certain assets and focusing on others. So with that, the plug and play ETF portfolio model is up. It was up last Thursday or Friday, I believe. And we're going to go through it today. We're going to cover all of the charts really quickly. And we're going to take a look at the broader market. We'll start there. First thing I want to show you is this chart from Forex Analytics. This is something you can get if you subscribe to them. I will share with you the best stuff. I encourage you to listen to their show in the morning, particularly if you are a swing trader. So if you are in the fundamental trends, rare swing trading chat room, and you are looking for ideas and you want to understand the technicals of the market and short-term trends, Forex Analytics is a free show every morning at 7 a.m. Eastern, 7 a.m. Central, so 8 a.m. Eastern, and then they have a guest. So for an hour and a half, they have a show that covers all the charts, from currencies to the market, to equities and commodities. And then they have a guest. Today I was the guest. Yesterday it was Mark Newton, who is an acclaimed technical trader, somebody that I now subscribe to. Tomorrow was Meb Faber. So Meb Faber is actually one of the gentlemen who I have modeled our ETF portfolios after. And he is suddenly a guest tomorrow on the same show that I was on. So I got stuck in between two giants, and I'm just flattered that they had me. So in any case, they're looking at the stock market the same way I am, that at some point we're going to get this correction. They too see a fairly significant correction. They're saying all the way down to 2,400-ish. 2,400 is on the S&P. Now, they're using their own handmade trend line. I'm using the 200-week moving average. They're fairly similar. I'll show you my chart in a minute. And this line here in the 2700s on SPY, this is the area that you will get to buy. I am unequivocally telling you, you will get to buy in this area at some point. Probably this year, probably after Labor Day, but it could happen sooner. We'll see. There are negotiations for the expansion of stimulus coming soon, and that is interesting in that there's a recess, a month-long recess that Congress takes soon. So if they don't get a stimulus and relief bill passed before they go on recess, if they choose to go on recess rather than staying and doing a stimulus bill, it signifies two things. One, that the Republicans aren't in love with President Trump. Two, that Democrats can't get what they want either. Right now, the Trump administration wants to tie aid to schools to whether or not they open, take the matter out of the hands of the administrators, and they also want to have a payroll tax cut that even the Republicans don't want to do. So we will see how these negotiations go. I suspect that the stock market throws a little temper tantrum if they don't do anything by the end of the month, when the extra unemployment benefits run out. So we will see what kind of volatility we get from that, but whether the stock market goes up to around here and comes down, or around here and comes down, whether it comes down to this level, which I've identified, or that level, you will get a chance to buy something relatively soon. You can see how similar that is to my chart. I also have similar levels. Here is my level in the 2700s. That was their first line. Then here's the level, and then here's the 2400 level that they talked about. So they're talking about a correction all the way down in here. I am allowing for the possibility that it could stop at any of these places. The first drop down may only be to about 300 on the SPY. We may get another rally before it comes down. Hard to know how the waves work because there's many different ways to count the waves. I'm using a weekly chart, and this is clearly more than 5. So hard to know the precise mechanisms. What helps is the technical indicators. And on the weekly chart, we can see the RSI has been approaching overbought for a while, hasn't quite got there. Money flow index has already turned down. Generally, this will pull the relative strength index down, which pulls the stock market down. Chaikin money flow is ambivalent, hanging around the even line. Little upward trend here, and I will discuss why that might be the case in a second. And MACD is still heading up on the weekly, on the daily, right? It came back a little bit, and now it's heading up again. So we could see it go like that before it turns over. We could see it turn over here. I don't like the way this looks. It looks like head and shoulders to me, even though I know MACD isn't really designed for that. But this pattern here generally would indicate a turnover sooner than later. And then the multiple moving averages that I track seem to be peaking again, right? Up near the top of the range, but not quite as high as it could go. So we will see if this rolls over or if it has a spike. I don't know if there's any way to know that. For the folks who want to chase, you better be nimble and you better be able to pull the ripcord quickly. Because if you're chasing, and you go flying over the edge, you better have a parachute. So folks who want to chase right now, you are making a mistake. It is emotional. You just want to keep up, or you want to catch up, or whatever, maybe some mustard. But it is not a smart thing to be a buyer if you think that the world is challenged right now, or that this rally has gone too far on Fed stimulus, because ultimately the stimulus packages are going to taper because budgetarily there are limits. So we will see. somebody mentioning the focus, and I am telling you that is your download speed. So let's go through the charts. Here's the first chart. Here's your smart money, dumb money confidence index that I've been focusing on over at Sentiment Trader. You can see that the smart money has perpetually been selling as the dumb money bought. So you have small investors at extreme optimism, and you have sophisticated rich investors selling to the FOMO crowd. How's that going to work out? Probably not that well. So we can overlay this with the stock market and see that when dumb money is all in, stock market usually has a correction, right? So dumb money started to get in, had a correction. Dumb money got in, 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 correction. If you are having FOMO, get some Fogyak, you ought to be scared. This is Newton Advisors, and he makes the point that everything that you've seen recently, actually in the last 3 to 4 weeks, has been rotation, rotation, rotation. This market is not expanding on strength or on volume. Volumes have been falling. There are fewer and fewer and fewer buyers in the stock market. To the extent that BlackRock, using the Fed money, can hold things up, I think that that is the best you can hope for right now. One of the things I mentioned on Forex Analytics, at some point, the Fed, who is bailing out all the corporations, is going to have to be bailed out. Because these corporations, as I've discussed before, even before coronavirus, couldn't handle the debt that was on their balance sheets, especially the no-growth companies. The no-growth companies are in big trouble. Ultimately, I expect the federal government to have some mechanism, whether it's using Social Security or the Treasury or whoever, somehow the federal government is going to allow most of the corporate debt on the Fed balance sheet to be converted into equity. Now, that's a few years off because most of these bonds are 3 to 6 years out, 5 years being the outside edge that they targeted, but clearly we know that they've gone a little bit over that. But 5 years from now, these companies are going to have to make good on these debts, or they're going to have to create new debts to pay off the old debt, or they're going to have to be allowed to convert their debt into equity. I expect that that's coming. Now, will that be part of an overarching solution to the Social Security shortfall that we face in a decade? I don't know. It makes sense to me that it would, but we'll have to play it by ear at the time, make a real-time decision. There's only whispers of putting stocks in the S&P 500. I think probably the consensus is that when this debt gets converted to equity, it will go to the Treasury, just like the Treasury already has some stock and stock warrants from these companies that borrowed money. So what is Mark Newton, one of the top technical analysts, saying? Short term, sure, SPY has got a little bit of rally left in it until it doesn't. Intermediate term, bearish. Same thing with QQQ. It could rally a little further, but once it breaks down, got pretty far to go. He's saying that July and August are questionable, but a big sell-off into October is expected. I'm telling you the same thing. Sell Rosh Hashanah. That is an old saying, and it's interestingly one of those things that tends to be true. And I would even throw out the conspiracy theory that a lot of Democrat money is not going into the stock market until after the election, because A, people are still afraid of Trump winning, and B, they don't want to help them win. So I think that you have a large portion of investable assets on the sidelines that won't get invested until Biden wins. For us, we need to buy that pessimism. We need to buy that fear sometime in October, in the days leading up to the election. Unless for some reason Trump is closing the gap rapidly, and then I don't know what to tell you. If Trump wins, I believe stagflation is going to hit us hard. So we go through these charts. Almost everything is short term. The rally could continue, but intermediate term bearish. Long term, no point in saying anything other than bullish, right? Things go up over time. Greatest country on earth for investing and for economic opportunity, even though we break it all the time and try, to fight about it. But again, if you're super nimble, you can trade these super short-term moves. But if you're more long-minded, if you prefer to just get good entry prices and hold for a while, you're going to get your chance, I think, before the election. Over at Data Trader Pro, it's a bullish trend day. This is what I'm using over at the swing trading site when I decide that I want to do it. One thing that scares me is the block transactions on SPY are at the bid. What does that mean? That means that there are some big institutional sellers selling into the stock market strength. A lot of it was yesterday, a little bit today. We'll see what happens later in the day, in the afternoon. If it's primarily buying by the institutions at the end of the day, market goes up. If it's primary selling at the end of the day, market comes down. I believe the institutions will be selling at the end of the day and pull this market down a little bit. I don't think there's appetite by the big investors to buy. QQQ went through the first resistance zone that I pointed out and is now in the second resistance zone. We would have to have the mother of all stimulus relief to get it to break out, because there's not a lot holding it back past these levels. I mean, it could really rally towards 300 if it gets through this level. And if that's the case, then that's the case. Then you just have a bigger correction coming later. I believe that this is the area to target on the very low end, around 150 on QQQ. On the high end, somewhere in the 190s. I still think a number in the 170s, which is about where it got to before, is probably what makes the most sense. The confluence of Fibonacci levels right in this range here, 180 something and 170 something, make an awful lot of sense. If we really are fearful of a collapse, if there's a couple of days where people say, oh my God, Trump is going to lose, I'm pulling all my money out, the people who are afraid of corporate income taxes going up a couple points, then maybe we get the oversell, and then that'll be the mother of all buying opportunities. ARK has rallied. We always like to compare ARK with Tesla. Tesla has pulled ARK up. It's a 11% holding. So if Tesla corrects, this could have a pretty big correction. I think that Tesla is benefiting right now from the short squeeze. At some point, the short squeeze ends, and people wait for it to reposition. I think that the small shorts, I think that the unsophisticated shorts on Tesla, the ones who are buying into anti-Tesla mantra, are the ones who have been getting squeezed out. And the new shorts will start coming in up here, and they've already started to do it. There's a record short holding again on Tesla after some of them washed out. ARK, I think you're looking for a price in the 50s. I don't know that it can get this low again. I mean, I allow for the possibility that it gets down towards 40, but I think if you can buy ARK in the 50s, 55-ish, that's probably a good level right there. Semiconductors. Oops. There we go. Semiconductors power the smart everything world. This level in here is kind of your consolidation zone. See where it got to here, came back, wiggled around this line, got above it, came back, got above it. I think you probably get consolidation back towards this line again. That is structurally where it feels best. That's where it feels like it's not too expensive, and that's where buyers come back in. So if we can get SOX under 200, I think that that's probably a pretty good deal. It's way up at 285 right now. It is not uncommon for semiconductors to have these big corrections. I mean, even back in the day, from here to here, still a 50% correction. So 30% is not at all that big of a deal. So look for SOX under 200. But 220-ish if the world's a lot better than I think it is. Wisdom Tree, quality, dividend growth, US. I have gone through all of these on ETF database, and you'll notice that if you look at the holdings of the ETFs that I'm suggesting, a lot of them have 20 to 30% of their assets internationally. I did that on purpose. I think that if the dollar gets a little stronger, short term, that's a buying opportunity because then the dollar will come down. And internationally, they have much better valuations than we have here. So the implied returns in the United States over the next decade from these levels are 2-3% annualized. That is what all the models show, 2-3% annualized. But if we get a big correction, then we can expect a good run at least into the next 4, 5, 6, 7, 8 years. I will tell you that I was looking at chart after chart after chart last night, and I am very afraid of what the end of the decade looks like. I do not like the way things look right around 2029, 2030, 2031, right in there. That seems to be, if you use Bayesian thought processes where you're putting in variables, you think about what's more likely, what's less likely, what's the bigger number, what's the smaller number. If you are a poker player, you think about implied odds, which is the expectation of what the next bet will be. You take a look out about a decade, and after we've stimulated ourselves probably into a huge rally, after gold has gone up, after tech has gone up, after the smart economy has gotten way overvalued, right? After the next bubble has blown, 8, 9, 10 years from now, there will be the mother of all crises because it'll coincide with the retirement system having a major, major problem. Between now and then, we need to make a lot of money. So we want to buy these buyback zones. If you are a retiree and you are looking for the best ETFs to grow your dividends and have a good total return, I think I have found the ones. I've been studying these all year. But I told you in the past, Wisdom Tree just does a good job of building their indexes and using some smart beta, just a little bit. Right? I've told you that the more complicated things are, the less likely it is to work. The smart beta that Wisdom Tree uses is just a hint, and it's just enough, and they tend to outperform their competitors. So if you want quality dividend growth, take a look at the holdings in here. Apple's a big one. Pulls back in here. So when I took a look at the holdings of all these ETFs, I wanted more smart economy stocks, smart everything stocks. I wanted more alternative energy. I wanted brands that couldn't be disrupted by Amazon. I wanted real estate that couldn't be disrupted by the stay-at-home economy. I wanted healthcare that wasn't reliant on getting a 1/100th share of a vaccine market that the government is telling us they're going to do at cost. This fund, I think, satisfies a lot of those things, being on the right side of the secular equation. The Wisdom Tree International hedged dividend growth. Same thing. Buy it in this box. This level could hold. You see the confluence. But if it goes through this level, then you have this range in here. So somewhere from the mid 30s down to the low 30s, I think is probably where we buy this. And again, if we retest the bottoms, because everybody decides that the world is ending and we get panicked, it could come down here. But then there's strong support again. It's going to be very unlikely that we get much through the bottom, even if we do get through the bottom. I do still think that the market is keying off of Trump being elected, and this level here would basically coincide with that theory that the market is going to undo the Trump rally. So I still think that this area in here makes sense. Doesn't mean it's going to happen, right? Because there's a lot of money being printed, and in real terms, in inflation adjusted terms, this level here is higher today, right? Just because of inflation, all the money printing. So the bottom of this box could for sure happen. I think the middle of the box is more likely. The tech NASDAQ dividend fund has done very well relative to peers, and it gives you a slug of technology with dividends. It's done very well. YieldCo. Again, same story. The one thing that you should worry about with YieldCos is that they're similar to the MLP model, and the MLPs rely on growth. So down the road, there'll come a day when the YieldCo model doesn't work, because eventually the growth will be gone. Now that's probably not for 20 years, but it's something to keep in the back of your mind. Plus it is tied to alternative energy, which is volatile. So with this, I don't even want to own it much above this level here. This 618 line is important to me. The 0 line is important to me. Those are long-term support levels. So right around 13-ish on the YieldCo, I think that is probably about where you want to be. A little, 13-ish, right in there. 1306, 1287, 13-ish. Now, again, if things get a little bit worse, there are levels that it can fall through. I have a hard time believing it would go through this level just because it's such an in-favor industry. But it could come all the way back down to here on general volatility, and one last guffaw by the climate change denier, I'm going to invest in oil and coal crowd. Wilder Hill Clean Energy Fund has done exceptionally well. How well? It's been the top performing ETF this year. And it has an international tilt. And it's not just solar. It's industries and materials companies that benefit from the shift to sustainability. Clearly, this chart doesn't make sense any more than this chart made sense. There will be a correction. Does it make it all the way up here first? Maybe. I don't know. Right now it looks like it will. But you have overbought going on. Multiple levels of overbought going on. So the money flow is starting to lag the RSI, but this is rallying too. I think that these all are indicative of blow-off tops. Does that mean there's another 10% to go? Maybe, maybe. 618 is a pretty important level. We know that, right? Because it happens over and over again. So we'll see. But But ultimately, this box is where I think you want to buy. The top of the box is right around 35-ish. And those levels might hold. I think there's a very good chance those levels hold. And in fact, it might make sense to think of this up here. This might just be a new thing. But I'm a scaredy cat, and I like to get a little value for my money. So I'm going to say this might be one of the few things where I buy the top of the box. Right around 35. Right now it's 48. And it could go lower. Again, alternative energy, a lot of people. But look at this trough in the breakouts. I think that this is not going to fill anymore. I think it tried to break down, and the market said, no, we like that stuff. Coronavirus, Fed rally, where's normalization? Normalization seems to be in here. Solar ETF for you, for you more aggressive folks. I think that this is the solar decade. So I think that you are going to want to buy on whenever this has a pullback. And I would just show you, it's had wild swings, right? Look. I don't think it's going to break out just yet. I think you're going to get a pullback to buy. So this pullback, how far could it come down? Well, this is pretty good starting support right here. So right around 36, tan becomes pretty interesting. And if we get more volatility and it takes some more levels down, could you get it down around 30? Absolutely. That's where I thought it was going before. And then we had this hyperactive rally. Charts that look like this are never good for your health. I do think that the stimulus that's coming will focus heavily on infrastructure. And I think it's important to look at a long-term history of the miners. Big downtrend, rally. I think that we probably could have bought it here. If it pulls back into this box, all the copper we're going to need to rebuild the world and the grid, all the zinc, all the lithium, all those things, iron ore, are represented by the companies in this index. So I think you buy the pullback. I don't know that you get it much below 19. Could it go all the way down into the 15s again, 14s? It could. It has to be a game time decision. But I think this is one where you can probably buy before, I don't think you're going to get a triple bottom here. You could, right? You could get a triple bottom. But I think that really probably right around 18, 19 is where you should probably start buying some of these. Because again, take a look at the companies, the top 10 companies. You just do this right on Yahoo. Look at the top 10 companies. And they do pretty well on these rallies. I mean, take a look at what happened after all the stimulus, after shovel ready. Right? It tripled. Under Trump, he had the Trump rally, it doubled. Actually, it almost tripled. I think from here, you probably see it triple again. It'll take 3, 4, 5 years. But if you can triple your money in 3, 4, 5 years, I'm guessing you'll be happy with that. International ideas. So one of the things I talked about on Forex Analytics today was how the world was decoupling from China. And certain countries would benefit from that. So Indonesia has both resources and good labor and enough technology, I guess. So they are going to send resources to China, and they're also going to benefit from some of the supply chains of Western companies and Japan moving out of China to other places. So Vietnam probably does pretty well. I haven't added them in here yet. But Indonesia has the double impact of not only being able to benefit from supply chains moving, but they're very resource rich. So I like Indonesia. If you get a pullback here into the 17-ish area, I actually think you can buy the top of the box. But if the world gets really rough for a little while, you know, the bottom of the box down here around 13 as well. I really like Australia. They're basically a Western country that supplies China, and they too will benefit from the decoupling of the supply chains. This is one that we probably ought to have bought down here. So I do want my second chance, right? Gonna play my second chance card. See this area right in here? All those lines, all the confluence. So 17-ish down to 15-ish, maybe 17, 16, right in there. I think that's where I really want to get involved. Germany is going to be a big beneficiary of the aid package. They're paying it, but it's good for their economy. So Germany fell off a cliff here. I mean, take a look at Germany long term, right? It's just a wild chart, right? Big moves. So when people tell me that these big, we're so far away from those lower prices, it happens, and it happens quick when it happens. So we want to get in on this, another 618 level and a 1 level, right? 1s and 0s, 618s, 0.5s. For whatever reason, certain levels happen. Big confluence right there. That's a pretty good floor. If it goes through that floor, then you have multiple levels in here that become very viable. So could you nibble around 25? You could. I don't think I will. I might sell some puts. It's really the lower 20s that I'm looking for on this. And I'm not a big fan of Europe in general. I just think that they're poorly managed. I think there's a lot of hypocrisy. The tribalism in Europe is something that they constantly fight against, right? It's been part of 2 world wars. They just have so many historical divisions that for whatever reason, no matter how hard they try to be unified, no matter how hard they try to pull in the same direction, and I'll even say the right direction, they have problems. And one of the problems with Europe is they don't realize how important the euro is. The euro should be the national competitor to the dollar, and they're just not committed enough to the idea of being a strong unified trade bloc to get it done. And ultimately, the fact that we have better natural resources and we're safer and we just have a better system than they do keeps us ahead of them. But Europe could be a main competitor for us if they ever got their act together. I do believe we've been undermining the euro on purpose. So if we get this last plunge down in Germany, you're going to want to buy it. And again, I think low 20s is what I really want to buy. Would I buy 25 if I thought the world was getting better quickly? Yeah, I would. But low 20s is probably where I'm looking. The euro in general is a trade that I made several years ago. And I said that the euro, when everybody thought the euro was going to break out and crush the dollar, right? There's been all this talk about the dollar getting beat up. I said the euro would get back to parity. So if you want to bet against the euro, I think starting in the next few months you can do it, because I think it's going to go down towards parity. Why? Under the Obama administration, the dollar got stronger. We're going to get more of that. So everything that happened in the Obama administration is going to happen again, but I think it's going to be more pronounced because they're going to have a Democratic House, it seems like, and they're probably going to have a Democratic Senate. And I frankly think the repudiation of the divisive hard right by the divisive hard left and the middle people is going to be substantial. Now, that doesn't mean that there's not a repudiation of the hard left at some point. Hopefully we govern from closer to the middle than the far left, and I think we will. But there are good ideas out there, and making the world a more sustainable place is at the top of a lot of investors' lists and a lot of government people's list. It's got about 70% support, including a lot of Republican support. So we should see America take the leadership on the clean world economy, the clean energy economy. We're already the leaders in the smart everything economy. There's Southeastern Asia, Asian competition, European competition, but the reality is we lead in most of those places. So as our leadership emerges, the dollar will get stronger, and Europe, because they don't really fix problems, they just kind of work through them and then they get to the next problem, the euro probably comes down. So over in the swing trading room, I think that we'll find some trades against the euro at some point. The Australian dollar is on our ETF list, and really it's so hard to buy bonds right now because interest rates are so low. We own Angel. That's probably the one chart I haven't shown, so I will put it up. But as those corporate bonds are converted into equity, we have to decide if we want that. And you as an individual investor have to decide if you want that. I believe that being in currencies that are going to have strength probably is smart. It's a good diversifier, not a huge position, but a little bit of money in the Aussie. It's the only currency that I really, really like. It's come way down, risen, come back way down. I think you can see the Aussie rise back into this 90-cent region, right? Will it set new highs way up here? It might. They're going to be a beneficiary of taking over a lot of the trade with China that the United States isn't going to do in the future, just because from an expediency standpoint, it's better for us to deal in this hemisphere, Canada, Mexico, South America, Central America. China is important, and a lot of our countries will stay in China to produce for the Chinese, but we're not going to produce in China for Americans, or in China for Canadians, or in China for Mexicans. We're going to produce for this hemisphere and this hemisphere. So that decoupling of some of those supply chains, not all of them, but some of them, and some of that manufacturing is going to be good for Australia. And the Australian currency probably rises like it normally does. And I think that this is a great way, if you want bond money, even though this isn't really a bond, you get a little bit of interest, not any less than you would in most stuff, but you get appreciation. So this currency is a bond alternative in my mind for people who want to utilize that strategy. If you don't want to use currencies in your strategy, that's fine. You're getting exposure to currencies through the equities that you own, and you can just add to some of your bond positions if you prefer. So this is the actual exchange rate, and this is FXA. So FXA, I think 65-ish is probably where you buy. Could it go a little lower if the dollar gets strong temporarily? If there's a spike in the dollar, sure. So if the dollar spikes, then this will come down and you get a better deal. I don't know if the dollar will spike. The dollar will drift up in general, but the Aussie is the one that's positioned to hold up well against the dollar. We looked at EWA back here. This was supposed to be Angel. These are the bonds that we own, right? This is where the Fed support comes in. But remember, 4 or 5 years down the road, some of these bonds have to be converted into equity. So up here around 30, and we're getting close. 31, there's the other level, 33, right? I don't know that you should own it above about 33. I mean, you can definitely trim just a little higher than we are now. I do think it rises because I think the Fed is going to keep supporting it. But we get up to this area here, you're probably going to sell it all. So this last 10% is where you're gaming it. Does the Fed take it from here to here? I think probably, but it's not a sure thing. And could it even go all the way up here? Man, I think that's a long shot, but there's enough potential for it to happen that I think the gravitational force pulls it here. Remember, gravity works in all directions, right? Gravity doesn't mean down. Gravity, if you're in space, can pull you to wherever the body, right, the mass body lives. And the massive body is the Fed. So the Fed's going to pull this up, I think probably towards 33-ish. When it hits this resistance, I probably would not want Angel anymore. I will probably put a sell order on Angel at 33. All right, let's take a couple of questions and then we'll be done. I am not extending any of my puts just yet. If we get volatility, I will do it then. You don't want to use the roll feature usually at your brokerage because you get screwed on the exchanges. You're better off to make a sell and then to make a buy if you're going to exchange one put option for another put option. Just make it 2 transactions. Don't use the roll feature. It usually doesn't benefit you. You know, you can put in parameters. If you know how to use the parameters, go ahead. It ends up essentially being like 2 separate trades. But I think it's easier just you make your sell where you think you should make your sell. The time value hasn't started to decrease all that bad yet. It will in about a week, maybe 2 weeks. So you should decide what you're going to do with your August puts, your SPY puts. Decide what you're going to do with your SPY puts probably right around here. First week of August. Take your loss if it's at a loss. But again, if this is coming down, right, then you just have to measure it. And these are trades. If you're buying puts, you know, hedging. And I haven't bought many. I think the first week of August, I'm probably going to buy more puts, and those will be for October or November. But I'm waiting because the first week of the month is usually a strong up week in the month. It has to do with inflows and outflows. As far as 401ks go, you know, in the plug and play portfolio, I found a good stock image. You have to decide what type of investor you are. Are you defensive? Are you cautiously optimistic? Or are you pedal to the metal? You have to define yourself. Don't look at the numbers first. Define yourself first. And if you are truly a defensive investor, I'd be as high as 75% cash right now, right? From 50 to 75% cash. If you're cautiously optimistic, I'd probably be around 50% cash, the high end of that range, you know, 15 to 50% cash. If you're pedal to the metal, 15% in cash, right? And if you're a great trader, you could be almost fully invested. But to me, the defensive investor is 3/4 in cash right now. The cautiously optimistic person is 50% in cash, and the pedal to the metal investor is even 15% in cash. These are the maximum cash levels that each type of investor should ever have. You should never be 100% in cash. You always have to have something that's at least in where you think the best places might be. So start with what type of investor you are. I think virtually everybody is cautiously optimistic. There are a handful of you that are defensive by nature, and you don't care if you trail the market. You just don't want to get beat up. And then you're pedal to the metal crowd. And even if you're pedal to the metal, it should be apparent to you that the trades are getting harder and harder, especially on the upside. So you need to be very cognizant of selling the rips more than buying the dips. So here's your portfolios. You can take a look at those when you get a chance. The global trends and the retirement trends are essentially the same. There's a heavier tilt towards the dividends here. So rather than 24% in QQQ, it's 12% in QQQ and 12% in the tech dividend fund. Instead of 12% in ARK, we add some dividend funds, right? So, you know, I mentioned XME earlier. You take a look at the holdings. You take a look at who it is. It's Newmont, it's Freeport-McMoRan. I mean, these are two companies that I really like. Worthington's pretty good. And this is international nature. Interestingly, core mining has been moving up the charts in a lot of the indexes. And I don't really understand the criteria that allows that. I have to look at why core mining has been holding up. And I don't know why the indexes have been adding it, but they have, and the stock has gone up because of it. So I have written covered calls on core mining. I'll be out if it stays at these prices a few more months. I haven't checked to see if there's news on Silvertip opening sooner rather than later. I mean, Silvertip wasn't supposed to open again until the end of next year. So maybe something's changed. I do like their assets in general, but to me, Silvertip was the thing that made that company potentially special. And I know they had another transaction recently. So we probably should revisit core mining if it's getting added to the indexes, because it has held up really well. Oil, I'll just finish on oil, I guess. Oil is going to be range bound above about $65 a barrel. The frackers start to produce too much, and below about $30 a barrel, nobody makes any money. So that 30 to 65 range is kind of an expanded range. I actually think it'll probably stay closer to 40 on the low end. It could. I mean, it could go down to 30 for a hot minute. The problem with USO is that USO, even with them changing the way they did their futures contracts, I mean, you just see the trend. It's just such a bad thing to trade. If you really want to trade oil, I'm just telling you, you need to learn how to use futures, and you need to take a lot of time to do it. I think it's interesting how the volume just completely collapsed. I mean, take a look at this volume and just look at that. We can do that with a lot of things, right? Look at the volume, just tailing off. Falling volume is not indicative of a strong buying group, all right? So keep that in mind. Last question is going to be on two questions, okay? Two last questions. Three last questions. Okay, stop it. Since we're in the stock market, I'll start with the Berkshire Hathaway question. I think that Berkshire Hathaway, just because it's so cheap and holds so much cash, is a good proxy for new investment into the smart everything and alternative energy worlds. They've shown that they're heading in that direction with their purchases of Apple and Amazon and all the alternative energy assets. They bought Dominion's natural gas pipelines, which I've been telling you for 2 years, the natural gas pipelines are in good shape. And they got it for a song. So, you know, in my head, I think that even though Buffett really just called Apple their third big business, I think that you see them get rid of a little bit of Apple. Now, if you just got fuzzy, that actually was my connection. You know, I never told anybody to short QQQ. So I don't know why you take some of these trades. I don't know what you should do. Because if it spikes up, you're going to get creamed. You know, you shouldn't make trades that you don't understand the technicals of. Decentralization of the utilities. Yeah, I'm going to write a pretty good article about the utilities You have to really, I don't know that we're going to buy the utility ETF anytime soon. You really have to own utilities individually for their own merit, because certain companies just still have huge transitions to do away from coal. And if they don't have really good transmission networks, they're in trouble. One of the reasons that WEC is good is because they own the transmission lines, and they're 60% owner of American Transmission. I think that's who it is. So WEC, if you want a utility, is probably one of the best ones out there, right? And it holds up pretty well. But if you get a dip down to here, 82-ish, right? I'll probably add these guys to our list, because I've been studying the utilities. I know that we want a few. They have to be cherries, right? And ultimately, investing is rank ordering. There's a lot of decent stuff out there, but do you really want to invest in it, right? You want the cherries. And that's why I've limited the stock portfolios to 20 stocks. The retirement income options will be a little bit bigger. It's a combination of sustainable growth and retirement growth and income. I'm about halfway done with those, because I'm updating the charts. As you can see on the very short list, there's more and more chart links. So, keep that in mind. All the ETFs have a chart link now. All the ones that are in the plug and play portfolios anyway. And I'll add more as we go. I do think that this is a utility that gets added to the very short list. I do. Because they have great transmission. They might have the best transmission in the country. Okay, and we'll finish up with DBB. I originally had this on the plug and plays, but I've decided that this is probably more for traders. The industrial metals are basically hitting resistance right now. So on a pullback, I think that let's even look at 5 years. There you go. That's what we want. So you take a look at your big line, just massive support down there. The retracement doesn't even matter that much because it happened. So where is the reversal? It's hard to know. This looks like one big trend down, right? So the reversal is down here. So if we look at this at a macro level and ignore the short term, see that it topped the bottom. And we should build micro levels in here for traders. But DBB could run to this level, 15 something, right? And it could even rally all the way up here to close to 18. I don't think I'd buy it unless it had a pullback, but I'm not sure how much it's going to pull back. I think that this is something that you have to look at the micro level. I think that the general trend is going to be up because of the money printing, and there's been a lack of investment over the last 5 years in materials, right? All the big companies, Freeport-McMoRan, BHP, Nutrien, regardless of what material you're talking about, they've all pulled back, right? They spent less capital on expansion. So if we're going to rebuild the world, the prices of these things are going to go back up because the combination of more money, more demand, and constrained supply. So I think if I'm a trader, I want to buy the dips on DBB. The problem is that it's a K1. So I'd probably just trade the options with this. The problem with that is that the options market is thin. So I'm not really sure what we need to do here. I think the answer is just invest in the miners, right? Just invest in the miners. We already talked about this. I think XME is the easy play for everybody. Right? I think XME is the easy play. You get your Freeport McMoran, you get your Newmont Gold, overlaps GDX a little bit. And I think that's the way you go. I think as the world rebuilds, we're going to need all these materials. If I can get, right, if I can get this under 20, basically, I'm probably buying it 19-ish. I'd probably buy XME at 19. DBB, I think it's just too hard to use for most people. I think you're better off with a futures account, and in which case, you know, if you want to do futures, start watching their show in the morning and brush up on it. There's great money to be made in futures, but it's risky because you're using margin, and I don't know that it's for the faint of heart. So I mean, if you're 30 something and you want to hit home runs and be a great swing trader, you need to learn futures. If you're 60 something and you haven't done it before, I'd skip it and stick with the equities. All right, you guys have a good day. That was a little bit longer than I wanted it to be because we got a lot to go through. We will focus on 3 or 4 charts a week going forward, and these will get whittled down quite a bit. But now that we've done the big one for the quarter, 20-25 minute updates from here on out. Everybody take care. Have a good day. I'm going to Costco.